You probably heard the old joke about a company that loses money on every sale. Somebody asked the manager how he expected to stay in business that way. He replied, "I'll make it up in volume." I'll forgive you if you didn't laugh, but I think you see the point. Without selling things for more than it costs to make them and get them to market, you just can't stay in business. That's why analysts check gross and net margins. Gross margin is gross profit divided by revenues or sometimes sales. This tells them how much of each dollar of sales is left to cover the costs running the rest of the company and go towards profits. Gross margins vary tremendously. Biogen's gross profit margin was around 85% each quarter from March 2012 through the first quarter of 2013. You can't sell a lot of oncology and immunology equipment, so you have to make a lot on the stuff that you do sell. In contrast, Kroger's gross margin was around 20%. You can sell a lot more groceries than you can expensive medical equipment, so you don't need to and can't demand a big profit margin in that business. Competition won't let you make that much. Just about everything we said about gross margin also applies to net margin. Net margin is net profit divided by revenues, or again, sometimes sales. Net margin is the part of each sales dollar that remains after we deduct those things we discussed earlier, like R&D and SG&A. You'll hear earnings per share, or EPS, mentioned a lot. You can guess what this is, right? It's the profit the company earned for each outstanding share of stock. You don't want to get too excited about a firm's EPS without more information. For example, if my shares are worth $2 each and I earn $1 per share, then that might be a big deal. If your shares have the same EPS of $1, but your shares are worth $200 each, then that doesn't sound like much. All else equal, though, a high EPS is better than a low one, and analysts like to see steady EPS growth from year to year. Let's do one more before we move on, the dividend yield. Perhaps you'll hear that a stock is yielding 3%. That means that the company pays dividends at a rate of 3% of its stock price. For example, if a stock pays out $3 in dividends over the course of a year and trades at $100, then its dividend yield is 3%. A high dividend yield tells me more about the nature of the company's growth than it does about whether it's a good deal or not. Mature companies tend to have higher dividend yields because they don't have a lot of growth opportunities and therefore aren't reinvesting their profits in new ventures. That's what mature means. They pay out all their earnings in dividends instead. A growth company needs to plow its earnings back into the company to take advantage of those growth opportunities. Lots of companies don't pay any dividends at all. Some of those are growth companies, and some are companies that have fallen on hard times. You'll notice that I haven't recommended that you spend a lot of time studying financial statements and reports. Let's face it, those are tedious and dreadfully dull. There's one exception. Go to eBay and find a copy of one of Marvel's annual reports from the 1990s through 2006. During that time, Marvel Comics had the wonderful policy of having their superheroes present the company's financial data. In 1991, the cover featured the colorful cast including Spider-Man, Captain America, the Incredible Hulk, of course, and others assembled in front of the New York Stock Exchange. How cool is that? The next time you watch the news or read an article about a company, listen for some of the terms we've heard today. You'll also pay attention to words and concepts that we didn't discuss today. Armed with knowledge from today, you'll probably be able to have at least some idea of what these unfamiliar terms mean. You're in a position to keep learning on your own. That's super. In our next lecture, we'll study the very inexact science of corporate analysis and valuation. We won't try to become experts in that either. No, the reason we want to learn about valuation is that by understanding what drives corporate value, we'll understand why businesses make some of the decisions that they do. That's always helpful.